Right, so using volume profile, where's the best place to trade? Now this is something that I think with a lot of volume profile stuff comes as a bit of a misconception. The easy answer to that is of course at the VPOC. This is the best place to trade. It's the place where most people trade. That's what forms the VPOC. So for anybody unsure, it's the volume point of control, the price where the most volume has been traded. So theoretically, this is the best place to trade. The problem with that statement is that assumes then that you're going to want to buy or sell at the level. And to create a VPOC, that's exactly what has to happen. The market has to trade across this multiple times to put volume at that place. So whilst it is a good place to trade if you want to get filled, i.e. if you want to buy, you're probably going to find sellers there. If you want to sell, you're going to find buyers there. Brilliant, you can get filled. But from a day trader's perspective, this provides no directional value. If the market is to trade across this price multiple times, how do you know which way it's going to trade when it reaches the VPOC? And there is no simple answer to that. So the way you have to think about it is the VPOC is a good place to trade for somebody who wants to build a position. Institutional traders, somebody who's trying to build a position over time, this is a great place to trade because that's where you get the greatest chance to get filled. As a day trader, what you're looking for is movement away from the VPOC and using the VPOC as a magnet. So think about it from this perspective. If the VPOC's the best place to trade and the market moves away from it, this is now good value for someone wanting to sell because they can sell it and the market should rotate back. So that's how to sort of think about a VPOC. Just because people want to trade there doesn't mean that this is a good place to trade for someone looking directionally. If we go and have a look at an example. This is an example in gold and it's from the 6th of November. Now what you can see here is a very balanced day. Now if you look at the full profile of the whole day, you can see that if you follow the green line in the middle, that's your VPOC. The market trades across this multiple times. If you buy every time you reach the VPOC, just as many times as it bounces, it will go through it and you'll lose money. If you sell, the same story. Now, obviously the VPOC is not there at the beginning of the day and it deviates throughout the day. But in the deviation throughout the day, the market is going to trade across one price and the VPOC shifts there and then it will shift away and the market will trade across another price. So if we look at it broken up, I've then split this into an Asian session, a European session and a US session. In each of these sessions, the VPOC formed within that session is a symptom of the market rotating. And so using the VPOC on any single day or the developing VPOC is never an ideal place to trade. It's a good place if you're short to get out. It's a good place if you're long to get out because there's a high likelihood you will trade there. But in terms of where's the best place to trade using a profile, the simple answer is the VPOC is not it. It's a good place to exit trades, not a good place to enter because the directional value of a VPOC is very, very limited on the current day. There's a lot of misconceptions with profile. It's one of my favorite topics, profiles. I think it offers so much, but you've got to think about it from the perspective of how do you turn this information into a trade rather than how do you understand where lots of trade is happening and what, ask yourself, what does that mean? Lots of trade is happening somewhere. That implies there's a very good balance of buyers and sellers, which is not conducive to direction. If you like the video, click subscribe, click on notifications. I'll be back soon. We'll do more on profile, we'll do footprint, we'll do order flow as well. See you all soon.